This is Joseph Phillips. In this presentation, we're going to examine enterprise analysis and the financial valuation of solutions. One of the first formulas you'll need to know is defining future value. Future value simply means what's a present amount of money worth in the future. The formula for future value is you take the present value of the money times 1 plus I, where I is the rate of return, to the power of n, where n is the time periods. So let's say you're getting an amazing rate of return of 6%, which that would be amazing now. Well, the present value is $145,000. So we would take $145,000 times 1.06 to the power of 3, that's 1.06 times 1.06 times 1.06, for 145,000 times 1.191, and that would be 172,695. What this means as far as solutions is that the present value of the investment for your solution should equal or beat $172,695 within 3 years. So if your solution cost $145,000 and it takes 3 years to complete, and it's only going to be worth $160,000 in 3 years, this isn't a good project to choose. It's not a good solution based only on the finances. Now, present value is just the inverse. It's what is a future amount of money worth today. So this formula, it takes that predicted future value and it divides it by 1 plus I to the power of n, where I is the interest and n is the number of time periods. So let's say in this example that you predict a solution will be worth $180,000 in 3 years. Well, it would be 180,000 divided by 1.06 to the power of 3 for $151,133. What this means is that the solution should not require more than $151,133 in order to begin, or in order to complete, actually. So if the project will cost more than $151,000 and it takes 3 years to complete, it's not a good choice. But if the project were to cost, let's say, $100,000 and it would take 3 years to complete, then it would be an excellent choice because $100,000 is considerably less than the $151,000 in present value. Now, some projects may have a series or intermittent returns on investment. So you have a series of cash flow or multiple years generating an income. Well, net present value looks at those projects and it finds the present value for each year that the project's in duration, and then it sums up the present values minus the original investment. So the greater that number is, the more worth that solution has. That's net present value. Now the payback period is simply how long to repay the debt created. So let's say that your solution will cost $250,000 and it will take 1 year to complete, but it will only earn $75,000 per year once it's completed. So the payback period means we take the $250,000 investment divided by the $75,000, and that means that it will take 3.3 years of cash flow plus the 1 year to do the project. So our payback period is 4.33 years until we break even. This is also known as management horizon. 4.33 years means after that point, then the solution is profitable. Now, a cost-benefit analysis, or CBA, it simply means it's the comparison or the ratio of cost to benefits. It helps you justify the project. If you have multiple projects, you can do some benchmarking to compare each other. Now, cost and benefits also consider the time value of money, especially when you have multiple projects to consider.